Welcome, everyone, and thank you so much for joining this quarter's Corporate Cash Briefing webinar. I'm Kevin Ruiz, a principal at Treasury Strategies, and I'm joined today by my colleague Tony Carfang, as well as our three panelists, Debbie Cunningham from Federated Investors, Steve Baseby from the Association of Corporate Treasurers, and Greg Favelovich from Fitch Ratings. As we've been doing for, at least the past 6 or 7 years, we are, as normal, going to be discussing the changes in corporate cash levels, and then our panelists are going to discuss the key issues that are top of mind for our corporate treasury audience. Before we begin, I'd like to remind everyone who's registered for this session that in a day or two, you're going to receive a copy of this presentation and a link to the recording. And should you wish to ask any questions, you can do so in the question box in the bottom right-hand corner of your screen. We'll handle these questions offline when the message is done, when this webinar is done. So if we could move forward to slide 4 here, we're going to start by talking about corporate cash levels. And the story really hasn't changed in this quarter as we expected it to. In the U.S., you look at our, again, for this quarter, our old friend tapering, and as we talked about the last 2 quarters, the question here is what of this I guess tapering is technical, and what's structural? As normal, we'd always welcome your thoughts on that. As you look at the UK, if you recall from our last session, we expected to see a much heavier magnitude of a climb as a result of Brexit, which we haven't seen to the same extent that we anticipated in this quarter's numbers. We expect to see that coming in January, and we will discuss it at our next corporate cash level. As you look at the EU, there's solid line growth here, although a little bit of tapering. And then Japan, as we said in the last quarter, the pace of the acceleration is accelerating, I think even more so in this quarter. As we look to our next slide, we'll see the story again. As we look at the regressions, the story isn't changing. This is a reflection of economic events as well as monetary and fiscal policy for 3 of these 4 jurisdictions. We see a fairly solid climb here as well. Japan, obviously not a fit due to policy differences, due to macroeconomic differences, and I think I recall our understanding from the last quarter is that there just isn't as much monetary and fiscal policy change as other jurisdictions did going into 2008. Everyone else was rising fast in the 2000-2005 level or into 2006, and I think that's still the disparity here, although we still do see a climb. Looking at slide 6, cash as a percentage of GDP, still high, particularly outside the U.S. You see these other jurisdictions rising rapidly. As we talked about before, the cash percentage of GDP ratio, it's a major measure of economic efficiency. And again, we would always be interested in hearing what you have to say on that. Slide 7 shows the correlations relative to nominal GDP. Again, Japan, another story. We suspect that's due to both structural and technical issues. But as you can see, for the 3 other major jurisdictions, the fit is very strong here. Looking at slide 8, the reserve balances, this is, as usual, the central bank's ability to attract reserves. We see a reflection in the data from the U.S. QE tapering. We see the Bank of England's flat for the last 4 years. If we expand this graph to a larger extent, you'll see that this is really not much movement for the Bank of England relative to the past. ECB continues to be a roller coaster, continues to climb. And then finally, Japan, this climb, again, with Abenomics and other macroeconomic drivers, there have been recent moves in the last 3 months to reduce the growth forecast, and this is still continuing to move. Finally, on slide 9, you look at the central bank balance sheets. Again, as we talk about, this closely mimics reserve balances, but adds in those total assets as a percentage of GDP. So GDP growth actually has a negative impact because it's the denominator. Again, we see pretty typical trends with the exception of Japan. So now I'd like to hand it off to Tony, who will give us an update on corporate and tax-exempt money funds. Tony?
Thank you, Kevin. Well, the time has finally arrived. After years of debate and regulation and hearings and comment letters, tomorrow is the day that money fund regulations finally are required to be implemented. What we're going to do today is go over a quick overview to set the table for our panelists, who will go into detail. We've got some great experts to talk about it. But I want to point out, at Treasury Strategies, we have been doing a daily countdown, and on our website, you will be able to see the daily statistics and track the daily changes in rates and asset flows as the money fund implementations impact the markets, and they are impacting the markets significantly. As you see on this chart, from yesterday was T-2, today is T-1, or as one industry pundit mentioned this morning in a paper that he's presenting, the eve of destruction. I'm not sure I'd go that far, but we're going to find out tomorrow, or we might find out later on from our panel. On this chart, we see a couple of things. The three asset classes of money market funds that are most impacted, as you can see here clearly, have been the prime, both institutional and retail, and tax-exempt money market funds. And since the beginning of the year, through October, about $1.15 trillion has left these funds and gone elsewhere. $1.15 trillion of assets that were supporting commercial paper, corporate commercial paper, bank commercial paper, asset-backed credit card debt, municipal debt, universities, hospitals, has declined by $1.15 trillion here on this chart at T-2. Now, I'm not going to go through all these statistics. You can see them on our website when you go into www.treasurystrategies.com. But a couple of things to point out here. The top box shows the actual asset levels and rates of change. We showed yesterday at T-2, prime funds were at $153 billion, down $717 billion since the beginning of the year. And actually, when you go to our website and see the T-1 chart, it's down another $11 billion today. Interestingly, you can see here that the prime and tax-exempt fund numbers of the decline is almost completely offset by the increase in government and Treasury funds. We'll talk more about that later. The bottom left-hand box, though, is really critical here. We've seen, as a result of these asset flows, a huge spike in short-term rates. Libor is up substantially from the beginning of the year. And keep in mind, the Fed rate hike was last December. So the Fed rate hike is already baked into the January 116 number that you see in the right-hand column there. So these are spikes well beyond that. The SIFMA index, which is an index on which a lot of municipal debt is based, has really skyrocketed, and it's been a real crunch for municipalities. Now, if we look at these graphically, I think and keep in mind these charts are stacked. So the area under the light blue line represents retail funds. The area between the light blue line and the dark blue line are institutional prime funds. Between the dark blue and the red are the tax-exempt funds, and so on and so on. So what this shows, interestingly, is that although the impacted asset classes have fallen dramatically, the overall level of investment in money market funds has not changed very much at all. And in fact, over the 2-year period that we've graphed here, it's been just about flat, a little over $2.5 trillion in funds over the past 2 years. So what that means is, as assets are leaving the prime and tax-exempt asset classes, they're not leaving money funds themselves. They're moving into primarily government money market funds. I was on a conversation actually showing this chart to a lawyer from a prominent D.C. law firm last week, whose comment was, this simply demonstrates that this regulation is nothing more than the nationalization of the money fund business. I actually think this is going to bounce back, so it may not be the nationalization. And in fact, as we at Treasury Strategies talk to our corporate treasurers who are our clients, we see that they've moved from prime into government funds, but not out of the asset class. They want to wait and see what's going to happen, and I think a fair amount of this money may be poised to move back in. Now, a couple of other things that are happening here worth pointing out is that the fund managers, and we're going to hear from Debbie Cunningham in a little bit to talk a lot more about this, are uncertain about whether how much in the assets are going to be leaving the impacted funds. So if you see the top two green lines there, which are Treasury and government weighted average maturities of those portfolios, they've been relatively flat over the 2-year period, in the neighborhood of about 40 days. But the impacted asset classes, the maturities are shortening and getting shorter and shorter as we get closer to tomorrow T0. The dark blue line are the prime institutional funds, which are most impacted, and the managers there are very, very short, under 10 days, as a matter of fact, is weighted average maturity, which is really unheard of for the asset class. Tax-exempt funds are, they've shortened from over 35 days to down to 30 days, or excuse me, 20 days, 15 days. So that's quite a shift. Now, one of the things that happens is when the maturities shorten, you can't extend along the yield curve. So we're also seeing a compression in rates. So as the prime funds shorten their maturities, the yield to investors decreases because they're not getting that maturity pickup. And the real question is, will the spreads widen as the maturities, the weighted average maturities, increase after implementation? And in fact, we're going to keep posting these charts on a daily basis after the implementation, because we think that once we start seeing an uptick in the weighted average maturities of the prime and to a lesser extent the tax-exempt funds, that will kind of be the all-clear signal. That means the people closest to the center of the storm, the portfolio managers, now have enough comfort that they're able to extend their maturities. When we look at the yield to investors, here we can see the impact of a couple of things that we just talked about. First of all, that SIFMA index that we mentioned earlier, which is the rate at which a lot of muni debt resets, is soaring. And so investors in tax-exempt money market funds, are earning the highest 7-day yields in the entire money fund universe. When you consider that there's about a 30 or 35% tax benefit, you would typically expect the tax-exempt yields to be 30 or 35% lower than the taxable yields. Just the opposite is happening here. The market is turned upside down. The other thing to look at here that feeds into the point I was making about the spreads is that dark blue line is the 7-day yield on prime institutional funds, and the dark red line are the government institutional funds, and those spreads have narrowed. If you go back to April and May, those spreads were in the area of 15 basis points or so, or maybe even a little bit larger. It's the distance between the blue and the dark green line, and today they're down to 10 basis points. And we think that's the result of the shortening maturities. On the next slide, we show here how asset flows are impacting the short-term borrowing costs of investors. And the blue and the black lines here show Libor, 1-month, 3-month, and 12-month Libor. And again, keep in mind the Fed rate hike was in December of 2015, and there hasn't been a Fed rate hike since then. So that's that little uptick you see in December 2015. Yet Libor has continued to increase. And the 1-year Libor is actually up more than 40 basis points over the period, and the 3-month Libor is up more than 25 basis points over the period. So that does show a little bit of stress or tightening in the market. The thing to remember about Libor is that Libor is the index on which most credit around the world is priced. So what we're talking about is outflows out of U.S. money market prime institutional funds, increasing Libor, which reprices debt globally. And to give you a sense of the magnitude here, there are somewhere, estimates range from 7 to $10 trillion of debt globally that is priced off of a Libor index. So these assets, these couple $100 billion or the $1 trillion that have left the impacted funds are impacting the reference rate on $5 to $10 trillion of debt globally. On top of that, ISDA estimates that about $350 trillion worth of derivatives, let me repeat that, $350 trillion of derivatives are priced off of Libor. That has the potential, as Pete Crane pointed out in his presentation this morning, to make this the eve of destruction. The final point I'd like to make here is that the cost to municipalities is keyed off of the SIFMA Muni Swap Index. That's the red line at the bottom, and that has been soaring. As a matter of fact, it has been as low as 1 basis point at the beginning of the year, and is now up over 80 basis points. I think most recently it's 87 or 88 basis points. So municipalities, universities, and hospitals are seeing a major impact on their borrowing cost. So the bottom line is assets are flowing out of prime and out of tax-exempt funds into Treasury and government funds. We think a lot of the Treasury and government fund money is on the sidelines, waiting to see if tonight is a Y2K event or not, and conceivably could begin moving back in, particularly as managers increase their maturities. Although it's an open question of what the new equilibrium will be. Keep following us at www.treasurystrategies.com, and you can get these charts and download these charts every day. Thank you.
Over to our panel. Our panel this week is Steve Baseby, the Associate Policy and Technical Director with the Association of Corporate Treasurers, Debbie Cunningham, the Chief Investment Officer for Federated Investors, and Greg Favilovich, the Director for Fitch Ratings. So Debbie, I'm going to start with you. Piggybacking on Tony's discussion about the money market fund reform, rather than talking about the eve of destruction, maybe we should talk about the yield curve to investors and what your thoughts are on that.
Certainly, if you look at the Libor yield curve, especially in contrast to the Treasury yield curve, the Treasury money market yield curve is pricing in with a little better than a 50-50 chance likely move by the Fed in December of this year, and then 1, maybe 2 next year. So it's currently about 25 basis points steep, going from basically overnights out to 1 year. Contrast that to the Libor yield curve, which Tony showed on some of these charts, and ultimately you've got a yield curve from a Libor perspective that's between 125 and 150 basis points steep. So it's obviously got the impact of reform associated with it, much more so than any impact of expectations from a Fed movement standpoint. So to be able to take advantage of that is a good thing. Now, historically, prime funds versus government funds on a spread basis have been around 15 basis points, and at this point are slightly less than that, maybe actually probably right on top of that, about 15 basis points, 16, 17 for some products. But ultimately, if you look at prime products that are essentially identical in investment nature to prime 2A7 funds, but without the overhang or impact of expectation from a cash flow standpoint with 2A7 changes, those funds' gross yields today are in the high 80s to mid-90 basis points. So let's just say it's 90 basis points to pick a number, and then let's just say government money market funds are at 40 basis points to pick a number. You're talking about a spread that's 50 basis points that will be realized by prime 2a7 funds, ultimately not tomorrow or even probably next week, but in the very near future as the context of cash flow and movement and ultimate conservatism from a liquidity needs perspective starts to be a little bit distant from prime fund managers. I can honestly tell you that prime fund managers at this point are not, unfortunately, able to invest to what would be, sort of the good relative value decision-making tools that, have historically been used in that process, and, taking advantage of what represents extremely good value along the Libor yield curve because of the conservatism and the concern about cash flows in the product and the need for liquidity. That will change, starting tomorrow, ultimately, but going into next week, next month. And, as we approach the fourth quarter, I don't think you're going to see a whole lot of change. You may see Libor retreat a basis point or two, maybe a handful, but it's certainly still going to represent extreme value, especially versus what is available in the Treasury and Govy world from a yield curve standpoint.
Sure. Thanks, Debbie. Yeah, that was something that we were thinking about, and I think you and I talked about that value play on the yield disparity between Treasury and Libor. Greg Fivilovich, a few seconds on your thoughts here. Specifically, I'd like to know what you think about the ability of corporates to play in that commercial paper market and really their ability to access credit in general. Craig? Well, we might have lost Craig.
Sorry,
yeah.
Kevin. Yeah, sorry, I wasn't sure if I got cut off, but
no problem.
So, I wanted to maybe piggyback off of kind of what Debbie said and what
Sure.
Tony mentioned about kind of the rise in rates. Certainly, it's impacting issuers in the short-term market, in the commercial paper markets. The rise in CP rates kind of shows you that some issuers are certainly willing to pay up a little bit more to access the funding that's remaining from money funds and other investors. But you can also see, on the other hand, that CP outstandings are down almost 20% from since April when rates really started rising. And I think what that's telling you is that for some issuers of short-term debt, the higher cost is making it not as worth it for them, and they're looking for other sources of funding. We've seen actually some issuers kind of move from issuing to U.S. prime money funds to tapping offshore prime money funds, which often are managed by the same managers and have kind of very similar strategies. We've seen some of these issuers, particularly on the financial side, try to adjust their funding strategy to take advantage of the growth in government money funds, where instead of doing CP or CDs with U.S. prime money funds, they'll do repo backed by government securities with the government funds, or search for other forms of long-term financing. So I think that's kind of an important
Sure.
thing to watch.
Sure, thanks. Steve Baseby, before I guess we want to stay on the money market regulations that are coming tomorrow. We're making a distinction between regulation and reform here in this room. Steve, in particular, coming from the UK, I kind of want to get your thoughts on this, as well as some of the thinking that you've had about what's going to be coming from the European side on money market fund reform and a directive that may be coming down the pike there.
Okay, well, the directive is still being debated in what's called a trialogue, which is in the three institutions of the EU. But the expectation is it will come out with a result that looks rather similar to the one you have in the USA. The point for trying to assess impact is that even if that's agreed by year end, there's about a 3-year phase-in process,
right,
which come into effect. So we will probably start to see the effect gradually come in and gradually develop over those 3 years. Well, I think it's more interesting is to look at the numbers on cash. I'm not surprised to see UK corporate cash rising. This is clearly a period of considerable uncertainty, and those corporates may well be holding cash through American branches in your money market fund market as well. But the push to hold more cash is really, in my mind, just a result of the uncertainty in the political field. Where it's held is a different matter, because whilst we look forward to changing the money market rules, and people will have to digest those and assess them, we also have changes coming in cash pooling rules, which in themselves make it less attractive to hold cash as cash deposits. And so if anything, in the short run, there may be a subtle push from deposits to money market funds while we digest the changes that will come into play. On the sort of background of that, though, I mean, obviously we're all aware of why people have got political uncertainty, which is the Brexit vote and how that's going to be completed. And within the EU, they have the rest of the EU. They have Dutch, French, and German elections coming up next year, which could impact again on the general political thrust of financial services regulation across Europe. Also making an interesting aside that although we talk about Brexit from a UK point of view, we're not quite sure who we're negotiating with at the moment. The governments in the rest of the EU may change radically before we can complete the negotiations. But I think look at the statistics. The driver here is political uncertainty to a greater degree, I think, than your own election, which is something you decide yourselves. The problem with Brexit is we don't decide it ourselves. The end result will be decided by 28 different governments, 27 of whom are somewhat annoyed with us for trying to leave. You may even see those figures, that line climb even higher. Today, the Scottish National Party decided it would put Scottish independence from the rest of the United Kingdom back into play. So times are becoming even more entertaining. But Absolutely. If we look at that overall, we do have this problem in the EU that something called CRD4, which is you would deem to be part of dodd-frank in legal effect, could start to affect pooling and the way cash is pooled and moved around Europe. We have those elections adding to the Brexit uncertainty. The money market fund regulations themselves are something a little bit over the horizon, but there's an underlying concern coming from our members, which is the risk that with elections in the USA, the elections within the rest of the EU, and the Brexit process, there's a risk of a divergence of regulation across the G20 as people pursue more political aims rather than economic ones.
Absolutely. Thank you, Steve. I appreciate it. You know, the conversation about regulatory uncertainty in country and political risk in general has been one that we've had here in the United States for some time. I think in the last year or so, we've started to recognize that our own political system, regardless of the outcome of the U.S. elections, is going to create, well, has created uncertainty and is going to create change going forward for both our banking partners and our corporate treasury clients as well. Debbie, I would ask you, do you have any other thoughts, not just about the U.S. elections, but also about globally what we're seeing from the UK, from France, from the EU in general, as well as just regulatory uncertainty in a broader sense?
Well, the regulatory uncertainty certainly adds a wrinkle to what you do from an investment process perspective on a day-to-day basis. It adds question, and you look at will policies and processes continue to be consistent that you're assuming and relying upon being so. So I think it basically the result is more conservatism. Obviously, money market funds are about as conservative from a quality, from a duration, from a liquidity perspective as you could possibly get in the marketplace. And uncertainty from a political and a regulatory perspective going forward just make that need or concern about conservatism even more dire.
Gotcha. Thank you so much, Debbie. Greg, did you have any thoughts on that as well? You know, we're gonna move here and talk from regulatory uncertainty to really talking about U.S. and global rates. And I don't know if you wanted to speak to that, Greg, or if we'd like to move forward and talk about rate differences for the rest of 2016 and going into 2017.
Yeah, maybe just to touch on one of the points that Debbie mentioned, kind of conservatism with funds maintaining high levels of liquidity. So we're certainly seeing that as well, and I think that's probably one of the most important points to look at kind of as we move forward, you know, post the regulations. So we keep track of all the institutional prime funds in kind of our universe. So about a quarter of them maintain 99% of the portfolio in weekly liquid assets. You know, and that's quite unusual for prime funds. We actually have there are a handful of prime funds, institutional prime funds, that maintain 100% of their portfolios in weekly liquid assets. And that kind of talks to the uncertainty where you know, the fund manager is not sure how investors are going to react, and you know, if some investors are going to be kind of very quick on the trigger if funds liquidity falls low, or you know, anywhere close to the 30% regulatory threshold that could trigger you know, at least the board considering imposing fees and gates. So by funds maintaining that much liquidity, they're really trying to eliminate any possibility of that happening. And I think that's something that investors will need to watch going forward. I mean, the liquidity is very high right now, partially because of the redemptions that we've seen, but I think it's also a structural kind of permanent change going forward, where fund managers are going to have to maintain very high levels of liquidity to avoid even the perception of getting close to, you know, where fee and gate territory is to make sure the investors are comfortable.
Well above that 30% level. Yeah, absolutely. Thank you. I want to pivot a little bit before we close out and talk about an update on 385, and just talk about U.S. and global rates for now as well as in the next year. I joined Treasury Strategies almost 3 years ago, and we've been talking about a rate liftoff since my first day, and prognosticating about it and so on and so forth. As we prepare for each one of these quarterly briefings, you know, we have our conversations beforehand, and it struck me that as we were talking about U.S. rates and global rates, we haven't seen a rate liftoff. We haven't seen a rate movement from the Fed since last December, and I just, you know, you lose track of time. So, Steve, I'm going to start with you here on global rates and get the international perspective, and then we'll move back to Greg and Debbie. Let me hear your thoughts. You know, we talked about negative rates, a flight to safety, even the risk of not having counterparties to invest in as we talk about, you know, regulatory reform. What do you think, as far as short-term, if not long-term, strategies for investing cash? What do you think, you know, our audience should be thinking about as they look at rates for this year and next?
Well, we get a clear message from our members that they're not necessarily focusing on rates.
Right.
If they're holding cash for several reasons, one of which is the uncertainty, one of which is a lingering uncertainty over the ability of the bank markets to deliver loan cash when required. And there's some evidence now that some are simply taking advantage of the long-term rates today to borrow and warehouse the cash somewhere, somehow. And as such, the rate is not the deciding factor of the short term. These are people who have choices as to whether they hold cash or not, but at the moment feel they have to hold it. And so they'll just take whatever the rate is. And moving to negative rates is simply an increase in the cost to carry. It's not really a move from positive to negative. It's just whatever their cost to carry is increases. I think going forward, though, the fact that people are borrowing long where they don't necessarily need cash is showing there is some concern or some belief that this rate cycle is coming to an end, even if only because eventually it has to. And in the British market, we have seen some effect of that as a result of the sudden drop of the pound. The government bond rates have started to move up Historically, they still are at modest levels, but when you look at the increases over a few months, in some cases, I think around the 10-year gilt, it's about 100% increase in the rate. So the long-term change has started. There's some evidence people are beginning to borrow long-term simply to lock in the rates. The short-term rates here are still very mild. They're very light. Nobody, whether you're a sort of an old age pensioner trying to protect your pot or whether you're a mega corp expecting to make money holding cash, that end is likely to stay low for some time simply due to the amount of cash swilling about in the system.
Sure.
But if we look at rates overall, the mood is that the low rate strategy is beginning to creak and doesn't look as though it's holding. Some of the side effects which central banks expected from lowering particularly long-term rates are not particularly valid, and the arguments begin to look a little bit weaker. And there are, so can leave it. I think we're at a turning point in the rates market. Longer-term rates have started to move up. Short-term rates still look quite soft, certainly for cash investors, if not for cash borrowers. I take the comments on the Libor curves, but in the UK, particularly the derivative markets, they're usually based on getting fixed rate swaps into place. So for the corporate, the Libor is a back-to-back exercise, and people are less concerned about where Libor technically is on the borrowing side.
Yeah, absolutely. Thanks, Steve. I'm not going to ask anybody except for Tony to prognosticate on the rates for this year and next. But Debbie, you and I, and we've talked a little bit already about this Treasury versus Libor yield curve disparity. Steve just touched on that. Is there anything that you would add to that conversation? I know we had also talked about the conversion from the Fed funds rate to OSFR, and you know, in the repo activity. I don't know if you wanted to speak to those points or no.
Certainly. I'd note a couple things. Number one, the Fed funds effective target rate, off which repo priced for decades, is now gone. That converted to the OBFR, the overnight bank funding rate, not quite a month ago, and basically they're right. The two indices are right on top of each other. So that's been a very seamless transition without any real impact. What is a little bit more impactful in the repo marketplace at this point is the elimination of J.P. Morgan, or the exit of J.P. Morgan from the clearing business. So essentially all subcustodial arrangements from a tri-party repo perspective go through Bank of New York Mellon now. No longer is it split what was kind of 80-20, Bank of New York Mellon, J.P. Morgan. J.P. Morgan has exited that business. So it's making it a little bit more concentrated, and I think, you know, to some degree, there's a comfort that it is a single provider that's very high quality, that has, you know, been in this business for a long time and operationally is very sound, but a little bit of concern about backup if things actually went askew. So I think there's a little concern there. And then the last thing I'd mention from a rate perspective goes back to what Tony had said. Really, the huge value, screaming value in the money markets at this point is in tax exempts. The SIFMA index at 80+ basis points for 7-day and daily paper is just amazing. Those rates are, upside down compared to where they should be. It has to do a whole lot with, exiting the marketplace from an asset perspective by institutional players. But by the same token, it's out there, and there's no reason that says you have to be a tax-free investor to invest in a tax-free security. If that tax-free yield is higher than a taxable yield, it doesn't matter that you don't get the tax benefit from it. It's overall a higher rate, and that's actually a really attractive portion of the marketplace right now.
Thanks, Debbie. Thank you so much. Very interesting stuff. So I'm going to put our panelist emeritus, Tony Carfang, on the spot here. and ask Tony his thoughts on rates, and then we'll close out by talking about an update on 385. So what do you think, Tony?
Sure, Kevin. Well, I think the combination of the political risk, the regulatory uncertainty, and the upheavals we're seeing in these asset flows, which are primarily asset flows out of private sector uses and diverted toward government uses, and that's now statutory around the globe, whether we're talking about Basel III or dodd-frank or the Volcker Rule or EMIR, whatever, everyone's required to hold government securities now. And that means that there's going to be pressure on private sector borrowing for a very, very long time. I think, when rates return to normalcy, the normal equilibrium is actually going to be at a higher level than we've historically seen.
Thanks, Tony. Just to close out real quick, I think we talked previously, and you wanted to give our audience an update on 385. If you wanted to do that real quick, and then we'll close up.
Sure. In our last cash briefing, we did a deep dive on IRS Rule 385, and so just to refresh, this is a regulation that was actually passed in 1969, and Treasury never wrote the rule to implement the regulation, and they're deciding that 2016 is the year to do that. And they're doing that in a way that's designed to curb corporate inversions, and all this is surrounding the issue of offshore cash. The rules, as were originally proposed several months ago, would basically create draconian penalties for activities that could easily be triggered through routine cash pooling or cash concentration that almost every corporate treasurer of a company of any size does. On the deep dive that we did in July, Congress is actually holding a hearing, excuse me, not Congress, the Treasury Department held a hearing, and the private sector pushed back really, really hard. The upshot of that, and Treasury Strategies comment letter, which we'd be happy to send to any of you who are on the line here, just shoot us an email, and we'll be happy to get that out to you. We basically said there needed to be some bright lines here, safe harbors, so that a corporate treasurer would know that a certain activity will not inadvertently trip the wire and cause the draconian penalties that the 385 would impose. Many other comment letters requested the same thing. So following that, there was a meeting between the staff of the House Ways and Means Committee and the staff of U.S. Treasury, at which I think the Treasury participants thought that they had reached a compromise with Ways and Means by agreeing to put in place some bright lines, and that would be the end of the day. Following that meeting, House Ways and Means actually issued a press release that says Treasury agreed with us, but in effect said, we don't think they even understood what we were talking about, which is quite scathing. It's a classic press release, and you can see that on the Ways and Means website. So following that release, Secretary of the Treasury Jack Lew actually met with House Ways and Means Committee Chairman Kevin Brady. Brady impressed upon Lew that this is a real complex issue in corporate cash management and Treasury, and the plumbing of the financial system is really, really complex, and this would require a substantial amount of give and take to come up with a rule that would actually create bright lines. So Brady was suggesting a fairly extensive process of additional hearings, comment, back and forth, industry participation, leading to perhaps in a year or two a rule that actually worked and would not upset the markets. Lew's response was essentially, I agree with you, but we're writing the rule and it's going to be out in a couple of months. And that's basically the last news to come out on the topic. So a little bit of uncertainty, except it looks like a cram down, and we can only hope that the lines that they draw are actually reasonably bright and provide some guidance for treasurers. However, we at Treasury Strategies are always available to help you think through your specific situations on this point.
Good save. Thank you so much to everyone today who participated, and thank you so much to the panel, Steve Baseby, the Associate Policy and Technical Director with the Association of Corporate Treasurers, Debbie Cunningham, Chief Investment Officer with Federated Investors, and Greg Pavilovich, Director with Fitch Ratings. Most importantly, on behalf of Tony Carfang and all of our panelists, thank you all so much for listening today. As usual, a link and copy of today's materials will be shared with all registrants in a few days. If you have any questions or comments, feel free to contact me or any of our panelists at our respective emails. Thank you so much, and we'll see you at our next cash briefing, Thursday, January 12th. In the meantime, stay safe, and we'll see you at this year's AFP in Orlando. Have a great day. Bye-bye.